Hey, what's going on YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Moomoo. Right now, you could earn an 8.1% APY on your uninvested cash by using my link in the description below. You could also receive up to 15 free stocks with my link right now. Terms and conditions do apply. So go ahead and check out Moomoo. I'll put a link to them in the description below. Also, make sure to check out the Discord. Completely free to join. So I'll put a link to that in the description below as well. Now let's get right into today's video. So today I want to talk about a strategy that I haven't talked about in the past that could be better than selling cash secured puts. So firstly, what is a cash secured put? So let me show you guys very quickly here by using Uber today as our stock for this example. Again, everything I'm showing you here is just an example. So let's go into the options here for Uber. So remember, usually when you're selling cash secured puts, you do so because you would not mind buying 100 shares of the stock. And a cash secured put allows you to get paid to potentially purchase 100 shares of the stock. And so let's say we wanted to sell a cash secured put on Uber. Let's say for our expiration date, we selected November 1st. So then we'd go over to sell here and we'd go over to puts. So let's say I would not mind buying 100 shares of Uber at $78 a share, and I want to get paid to potentially do so. So again, one thing we could do here is sell cash secured puts. So here is the put at the $78 strike. So I would go ahead and select this here. So for selling this cash secured put, I would get paid a premium. How much? $248 per share. Each contract controls 100 shares. So we multiply that by 100, I would get paid around $248 to sell this cash secured put. Now in exchange for that, we have to put up some collateral. How much? Whatever our strike price is times 100. So our strike price is 78 times 100. That means I would have to put up $7,800 in collateral to be able to sell this cash secured put. Now at expiration, one of two things could happen. Either the share price of the stock is at the strike price of the option I sold or higher. If that's the case, this option would expire worthless. I'd get my collateral back, and I basically made $248. The second thing that might happen at expiration is the share price is less than the strike price of the put I sold. If that happens, then I would still keep $248, the premium I received, but now the $7,800 in collateral I put up would be used to purchase 100 shares of Uber at $78 a share. Now let's quickly take a look at how this looks like from a visual standpoint. And so we can do that by using OptionStrat. So I'll put a link to OptionStrat in the description below. Really great options visualization tool. Now if we go to build here, notice under income, there's a cash secured put link that we can click on here. So let's go over to Uber here. And then for our expiration, I selected November 1st for today's example. And then remember, we said we wanted to sell a put at $78 a share to potentially purchase 100 shares of Uber at $78 a share. And again, get paid to do so. So again, for this example, we'd get paid around $261 for our credit. Collateral would be $7,800. Here's our max loss, which is our collateral minus our credit. Max profit is the credit we received. According to OptionStrat, if you have the premium version of OptionStrat, they say our chance of profit for this example is 68%. And then we have our break even here. And then again, we have our profit and loss chart here. So this is really useful here. So we can kind of see what our profit or loss would be depending on the share price, depending on the date, we can also mess with implied volatility here. So this is what a cash secured put looks like. Now, what if there were a way for us to potentially make more profit by doing almost this exact same thing? Well, there is. And that's what I want to talk about now. And usually we only want to do this when we're neutral to slightly bullish on the stock. So in other words, we don't believe the stock will move a whole lot to the upside, but we think it could move a little bit to the upside here. And so let's take a look at how this looks like. So let's go back to Robinhood here. So we're still going to sell our cash secured put like we normally would. So everything that we've done up to this point, we would do the exact same thing. But now we're going to do a few extra things here. So let's say that for Uber, let's say that we don't think Uber will go over $80 a share by the time our expiration date comes, right? So we're still neutral to slightly bullish on Uber, but we don't think it's going to go above $80 a share. And let's say we're looking to potentially make even more potential profit than what our cash secured put would potentially make us, but still selling our cash secured put. So what we are going to do here then is we're going to sell a call here. So we're going to switch over to calls, and we're going to leave this on sell, and we're going to sell a call here. And we want to sell a call at the strike price of whatever price it is you don't think the stock will go above. So again, if we don't think Uber will go above $80 by our expiration, then we would sell a call at the $80 strike. If we didn't think Uber would go over $81 a share by our expiration, then we would sell the call at the $81 strike. So again, for this example, let's say I don't think Uber will go above $80 by our expiration, so I'm going to sell a call at the $80 strike. Now, we also want to go ahead and buy a call now. So let me switch over to buy. We want to buy a call with a higher strike. Now, this next part is very important. We want to ensure that the width of our call spread, because that's what we're entering now, is a call spread as well. We want to make sure that the width of this call spread is less than the premium received from the cash secured put that we're selling to ensure that there is no upside risk. So the put that we're selling, we're receiving 248. So we want to make sure that the width of our call spread here is less than 248. It's not wider than 248. So if I buy the call right above the call that we're selling at the $81 strike, that's only a width of $1. So that's less than the credit we're receiving from the cash secured put that we're selling. So that should be okay. So I'm going to buy the call at the $81 strike. And so this is how we would set up this strategy. And by the way, this strategy is called a Jade lizard. So let's go over to option strat now. Let's visually take a look at what this looks like and compare it to our regular cash secured put. So let's go to a new tab here in option strat, and let's go to build. And again, let's just start with a cash secured put here. So again, we're using Uber for today's example. The expiration date that we selected was November 1st. We're selling our cash secured put like we normally would. So I'm going to do $78 strike again. And again, so what we're doing here is we want to say, okay, I don't think Uber is going to go that high if it does go up. I don't think it'll go above $80 a share. So again, we're going to go ahead then and sell a call at the $80 strike. So right here. And now again, we want to buy a call with a higher strike. We want to make sure that the width of this call spread is less than the credit we're receiving from the put that we're selling. So I said the one at the $81 strike should work. So I'm going to buy a call at the $81 strike. So you can see option strat recognizes this as a Jade lizard. And so now let's compare this to the regular cash secured put here. So the first thing you're going to notice is that with the Jade lizard, our potential max profit is higher. Here our max profit is 307. With a regular cash secured put, it's only 261. So we have the ability to make more profit here with the Jade lizard. Also, notice that our break even is lower. So break even with the Jade Lizard, 74.93. Break even with our cash secured put, 75.39. This also means that our max loss is lower, right? So our max loss with the Jade Lizard, 74.93. With the cash secured put, 75.38. Also notice that the chance of profit, according to option strat, is going to be greater for the Jade Lizard, 70% versus 68% for this particular example. Now, where are we going to make our max profit here of 307? So again, what we want to happen here, the ideal situation, is that the price of the stock stays between the strike of the put we sold and the strike of the call we sold. If it stays in between there, you can see we're going to make our max profit of 307. Now the con here, though, what you need to, again, keep in mind, is that we're going to make less if the stock has a bigger move than we expected. Let's say it actually goes up to, 82.10, for example. Well, now with the Jade Lizard, we're only going to make $207 versus with the cash secured put, right? We're going to make $262. Because as long as this option expires worthless, the cash secured put we sold, as long as that expires worthless, we receive our entire premium at expiration, which again would be $262. So again, that's why you want to make sure if you're using the Jade Lizard, that you're neutral to slightly bullish on the stock, that you don't think the stock will go higher than the strike of the call that you're selling, that you think it's going to stay between that and the cash secured put you sold. And if that indeed happens, you can see we can make some extra profit here. So anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, a link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.